In mid-July this year, reports circulated on Chinese social media claiming that real estate tycoon Pan Shiyi, who currently resides in the US, could face a tax evasion penalty of up to $1 billion imposed by Chinese authorities. This stems from the announcement on relevant matters concerning individual income tax on offshore trusts, issued by the Ministry of Finance and the State Administration of Taxation on July 24th. On August 5th, the Financial Times reported that Beijing had launched a global tax hunting campaign against the super-rich, seeking to recover hundreds of billions of dollars in unpaid taxes accumulated over the past decades. If you happen to know any wealthy individuals in China, please tell them to flee China as quickly as possible. The CCP's crackdown on the wealthy has only just begun. In this episode, we'll focus on this topic. Let's first listen to what this lady says about her client's latest experience. Recently, one of my clients and his $500,000 were investigated. He was asked, how did this money flow out of China? This is a true story. My client messaged me a couple of days ago saying that the State Administration of Foreign Exchange called him, asking him how his $500,000 from a few years ago went out of the country. He replied, for tourism. Actually, he was quite careful at the time. The State Administration of Foreign Exchange then said, then send me your overseas spending records to see if they match this figure. In the end, he didn't. This leads to a theory I told him a long time ago, which he didn't take seriously back then. Now he's telling me, why didn't you tell me sooner? It's called the 3B theory. This is your local currency, this is your foreign currency, and this might be your digital currency. Usually everyone does it like this. Even like this, the 3B theory tells you that money should flow in this way. Money should flow in this way. I think that's all I'm allowed to say. This lady in China can't say too much because China's internet censorship is very strict. What she wants to express is that wealthy people in China need to learn to diversify and undirectionally flow their money across the three areas of local currency, foreign currency, and digital assets. This is a common practice in cross-border fund management aiming to reduce the risk of being traced and investigated by tax or foreign exchange authorities by diversifying the sources and flows of assets. The actual effectiveness of this approach remains unknown, as the Chinese Communist Party is now heavily using AI technology. Many of China's ultra-wealthy individuals have been using offshore trusts to hide their wealth abroad. On August 5th, the Financial Times reported that Beijing has launched a global tax repatriation campaign targeting the ultra-wealthy, aiming to uncover hundreds of billions of dollars in unpaid taxes over the past decades to fill a worsening fiscal deficit. This campaign focuses on profits derived from the purchase of assets such as real estate, stocks, precious metals, and cryptocurrencies. Multiple officials, bankers, and consultants have confirmed its retroactive nature, with some cases dating back to the year 2000. The report states that the CCP is using AI technology to analyze investment records with extremely high efficiency. Now let's look at the story of Pan Shiyi, one of China's most successful real estate developers. Recently, rumors have circulated online in China that he faces a huge fine, but the CCP has not issued any official announcement yet. In 2026, a New Year's photo of Pan Shiyi and his wife Zhang Xin released in New York shocked the entire Chinese real estate industry and capital market. While many of China's real estate giants were mired in debt crises, project halts, plummeting stock prices, and liquidity shortages, this couple calmly began a new chapter in real estate development in Manhattan. Pan Shiyi is a grassroots entrepreneur who rose from a very poor rural area in northwest China, Tianshui City, Gansu Province. Some believe that Mr. Pan's greatest success was marrying Zhang Xin, an American citizen. Miss Zhang was born in Beijing and moved to Hong Kong with her parents at the age of 14. She later graduated from Cambridge University with a master's degree in development economics. She married Pan Shiyi in 1994 and returned to Beijing in 1995 to co-found the real estate company Soho China with her husband. Soho China Cayman has established 7 BVI companies that control 7 real estate project companies in China. Pan Shiyi controlled 47.39% of Soho China's shares through Boyce, and Zhang Xin controlled another 47.39% through Cape Vale, giving the couple a combined 94.78% stake. In 2005, Pan Shiyi transferred all his Soho China shares to his wife free of charge. Zhang Xin then transferred all her shares in Boyce and Cape Vale BVI to Cape Vale Cayman, effectively placing 94.7% of Soho China's shares into a family trust in the Cayman Islands. Finally, Zhang Xin granted all her shares in Cape Vale Cayman to HSBC Trust. This private trust's biggest advantage is its ability to secure the shares. For example, Zhang Xin included an irrevocable clause in the trust terms. Zhang Xin is the settlor, protector, and sole beneficiary of this trust. A trust is a tool for wealth succession planning used to protect assets and prevent significant losses due to family disputes, inheritance battles, divorce property division, debt collection, etc. For families doing business in China, it also serves as a powerful safeguard against the Chinese Communist Party. In 2007, Soho China successfully listed, raising $1.9 billion, creating the largest commercial real estate IPO in Asia to date. After the listing, Pan Shiyi remained active in the media, while Zhang Xin seemed to disappear. In fact, in 2011, Zhang Xin ranked among the world's richest mothers on Forbes' list with a net worth exceeding $1 billion. Pan Shiyi himself received zero income and had no management rights. Essentially, the money earned in China legally and compliantly became the assets of Ms. Zhang Xin, a U.S. citizen, completely isolating her from risk. Therefore, over the past 20 years, no taxes have been paid to the Chinese government on the appreciation, dividends, or transfer gains of these assets. Pan Shiyi and his wife recognized the risks of a Ponzi scheme in China's real estate market much earlier than many other real estate tycoons. During the industry's most frenzied years, almost all real estate companies were operating with high leverage, high turnover, and aggressive land acquisition. In 2012, Pan Shiyi publicly said that the golden age of real estate was over. Soho China made the opposite choice to the rest of the industry. It stopped acquiring land, expanding, and pushing sales figures, instead focusing on existing assets and strictly controlling debt. From 2014 onward, Soho China began selling off assets, successively selling its core assets in Beijing and Shanghai, raising nearly $4.5 billion, all of which was transferred overseas. As the major shareholder, Zhang Xin received over $1.9 billion in dividends. The couple later decided to discontinue the entire company, intending to sell it to Blackstone for nearly $3.8 billion. However, the Chinese government did not approve this. In 2022, Pan Shiyi and Zhang Xin resigned from all management positions, completely withdrawing from the industry. At this point, Soho China was essentially an empty shell, with a market capitalization of only $250 million, a drop of over 90% from its peak, and this was no longer related to the family wealth of Pan Shiyi and his wife. After withdrawing from the Chinese real estate market, the couple did not stop. Zhang Xin, using the family office as the core, began a new chapter in Manhattan's real estate industry. On July 24th of this year, the Ministry of Finance and the State Administration of Taxation of China issued the announcement on relevant matters concerning individual income tax on offshore trusts. The offshore trusts referred to in the announcement are trusts established under foreign laws or other foreign legal arrangements with trust functions. Chinese residents transferring assets into offshore trusts or income obtained through offshore trusts must declare individual income tax. The new regulations include income generated when Chinese residents place assets into offshore trusts, income generated during the trust's existence, and liquidation proceeds after the trust's termination, all subject to taxation at a 20% rate. Some individuals who have already established offshore trusts also need to declare and pay previously unpaid taxes. The CCP authorities have demanded that relevant taxpayers declare any outstanding taxes owed and unpaid within 90 days of the announcement's implementation. That is, before October 22nd. Concealing such claims will not only result in a payment of 20% tax, but may also lead to back taxes and late payment penalties. If illicit funds are involved, prosecution is also possible. Therefore, in late July, rumors circulated widely on Chinese social media that Pan Shiyi needed to pay approximately $250 million to $300 million in back taxes. If the trust is ultimately liquidated, the total tax burden could reach $600 million to $1 billion. However, a common question among Chinese netizens is how the CCP will recover these taxes from Ms. Zhang Xin, an American citizen. They wrote, "I don't understand. I don't know if they will cooperate. What if they don't? There's no such citation statute between China and the US. Old Pan's family has already become US citizens. What else can we do if they don't pay this tax? There's no departure tax. We can only wait for the US to collapse before we have any leverage. Who knows when that will be? The key is whether it can be effectively implemented. The government treasury is tight, so they finally couldn't help but take action." Many Chinese people on the X platform have the same questions. One person wrote, "If Pan Shiyi refuses to pay taxes, what methods will the CCP use? Because how the CCP deals with Pan Shiyi sets a benchmark for other wealthy people who have hidden their wealth overseas. I'm referring to both legal means and underworld methods, curious seeking advice. Many Chinese believe there's no need to worry about Pan Shiyi. Pan and his family have long been non-Chinese tax residents. The reason Mr. Pan fled is to seek protection under different legal systems. As for the assets remaining in China, they have long been hedged against risks. Jiang Xin's asset transfer plan is very meticulous, and a strong legal team acts as a firewall. The CCP has virtually no effective means to prevent this. Our channel has consistently told viewers that the CCP will try every means to resolve its enormous debts in the coming years. It's only a matter of time before the Chinese tax authorities target the overseas assets of the wealthy. Mr. Pan's swift action was due to his clear head. Both of his children now hold U.S. citizenship. In 2021, Pan Shiyi's eldest son, Pan Rui, was placed on a nationwide wanted list by the Chinese government because on June 23, 2020, Pan Rui commented on the deaths of Chinese soldiers in the Sino-Indian border conflict, saying, "At least one camp was buried alive. There was no chance of a sky burial." The following year, the official Weibo account of Haidian branch of the Beijing Public Security Bureau accused him of spreading rumors and defaming heroes and martyrs, urging him to return to China as soon as possible to face investigation and processing. Offshore trusts have long been a standard feature of the wealth structure of China's top billionaires. According to publicly disclosed information, almost all founders of leading private listed companies in China have established offshore structures before and after their IPOs, covering core industries such as real estate, internet, and consumer manufacturing. However, many entrepreneurs ultimately lack the courage to completely separate themselves from their business in China, obtain foreign citizenship, and relocate their whole families overseas. For tycoons like Jack Ma, it's impossible to completely separate their assets from China. Although they can take some funds overseas, the majority of their assets remain in China. Therefore, they are now like meat on a chopping block. According to new regulations, the amount of back taxes is directly linked to the dividends of listed companies. Some have calculated that several of China's wealthiest families will have to pay back taxes of approximately 200 to 500 million. For example, the Zhang Yang and Xu Ping couple who own the Haidilao restaurant chain will likely have to pay around 200 million. This wave of tax audits in China is not simply about tax inspections, but about making overseas assets transparent, traceable, and taxable. For the CCP to levy taxes, it first needs to know the distribution of the wealthy's assets and conduct comprehensive, detailed collection and monitoring of their overseas investments. It now appears that the CCP has completed its comprehensive control over these wealthy individuals, and the party will use various means to recover profits from those that the wealthy have moved abroad, and potentially forcing wealthy individuals to repatriate their funds from overseas. The new regulations have been met with ridicule from Chinese netizens on X. One netizen wrote, "Wouldn't it be even better to legislate to collect property taxes that haven't been levied since the Qing dynasty? The sword of the Qing dynasty beheading the officials of the Ming dynasty?" Another netizen commented, "This will trigger a new wave of capital flight, and it'll be a costless exodus." Indeed, it's foreseeable that the CCP's tax reforms will accelerate wealth transfer and the physical fleeing of the rich. On August 4th, CNBC reported that China's super rich were shocked by the new tax regulations and scrambling for cash. With the official deadline fast approaching, wealthy Chinese were frantically calling lawyers and private bankers. "This is a watershed moment for private wealth planning related to China," said a Singapore-based lawyer. However, it's now extremely difficult for wealthy individuals to escape China. They may only have one more month. The Chinese authorities recently announced a new version of the exit and entry management regulations, which will officially take effect on September 15th of this year. The regulations cover dissuading people from leaving high-risk countries, administrative restrictions on personnel involved in export controls and technical security, granting county-level authorities the power to make independent exit restrictions, and comprehensive regulation of immigration intermediaries. Some power has been decentralized, giving local governments the power of life and death over entry and exit. If wealthy individuals want to physically leave the country, they must pay more taxes and make more contributions to satisfy the extortion needs of local governments and specific officials. Alternatively, they may be used as hostages or bargaining chips to secure the departure of other family members. These scenarios are all possible. If wealthy Chinese want to leave but cannot, they usually resort to methods of separation, such as prioritizing the flight of money or family members or pursuing structural changes. This includes paying back taxes for security, diversifying assets, and using family members' overseas identities to restructure trusts or corporate equity. But this carries a higher risk of illicit capital outflow. It should be noted that the CCP is not targeting its own people, such as the powerful families of the high-ranking CCP officials. The CCP will classify and deal with them accordingly. This group is likely targeting private entrepreneurs. The CCP's pursuit of taxes is mainly due to China's fiscal collapse, and the government is trying to find ways to make money. Those wealthy individuals and even their frontmen, if their backers are not strong enough, or if their backers have already collapsed, will be exploited. China's budget revenue relies heavily on taxes. With the continued slump in the real estate market, land sales revenue, once a core source of national revenue, has plummeted from a peak of 8.7 trillion yuan in 2021 to 4.15 trillion in 2025. On July 22nd, the Chinese Ministry of Finance released its semi-annual fiscal revenue figures, showing that all provinces had fiscal self-sufficiency rates below 100%, with revenues falling short of expenditures, including Shanghai, long considered China's wealthiest city. This situation is similar to the CCP's reform of national capitalists in the 1950s, which also began with anti-bribery and anti-tax evasion campaigns. The 5 anti-campaign of that time resulted in numerous wrongful convictions and miscarriages of justice, leading to the persecution and suicide of many capitalists and businessmen, as well as executions or torture to death. It's noteworthy that on June 19th this year, Xinhua News Agency published a high-profile article praising the socialist transformation of 1953 to 1956, particularly the joint public-private ownership of capitalist industry and commerce. Another foreseeable consequence is that the private capital and entrepreneurial spirit in China will be drained, and Red China will become more closed. Throughout history, authoritarian regimes typically begin their demise with a financial crisis and end in a social crisis. The CCP is no exception. In our view, the CCP's 25-year retrospective tax investigation probably can prolong its existence, but will not save it. That's all for today. If you enjoy our content, please give us a thumbs up, subscribe, leave a comment, or share it with a friend. We appreciate your support, and we'll see you next time.